Welcome,
We have a group
guys,
of
and
14. Go ahead.
welcome, and thank you for joining. It's a treat to be here. So Pat, I'm going to kick it off to you. Maybe just to start, just why don't you give an introduction of yourself, how you got where you are, and I guess if you can look back on the lessons that you've had over the last years as an investor, what are the key lessons that you've learned?
Well, I'm proof that if I can succeed in this business, anyone can. I've never had a finance or accounting course or an MBA, and I just had to figure it out on my own. So for those of you who are learning about investing as high school students or, taking finance classes in college, you're way ahead of where I was at that point in my life. In terms of lessons, I think probably the single biggest one is that the scarcest resource is not financial capital, it's human capital, right? Each of you, there's 24 hours in a day, and when I think about the research time that I have with my squad here, there's four of us, and so that's 200 hours a week. Each of those hours is really precious, and how you spend them is really precious. And so you always want to think about it's kind of like radioactivity. What's the half-life of the information I'm getting? And like the half-life of somebody's opinion about what the Fed will do is about 20 nanoseconds. The half-life of what will unemployment be next quarter is about 10 nanoseconds. But the half-life of an annual report, where you learn something about a business that you can then apply to the next business you learn, that's got a lot more shelf life to it. So as hard as it is to kind of block out a lot of the CNBC and the stuff that's bombarding you all the time, just think about how useful will that information be to me next week or next month. And if it's not worth spending a lot of time on. So that's took me a long time to figure that one out. But I think it's worth remembering because at the end of the day, what makes investors great, it's not just discipline and patience and all that yabba yabba, but it's pattern recognition. It's knowing a lot of businesses and being able to say, okay, this one kind of looks like that one I looked at last year, and so I can shortcut to thinking about what's important.
All right. Thank you, Pat. So with that, why don't we kick it off to questions for Sussex Tech? What questions do you have for Pat Dorsey?
Well, some of those questions are probably going to be dismissed due to the fact that we only have 5 minutes left, but we'll try to make the most of our time. Anybody want to volunteer, or else I'll start calling upon you? We have some very good questions. All right, we have Trevor here, Trevor and Ryan. I split them into groups, and they developed some questions or topics to discuss with you, Mr. Dorsey.
Sure, fire away.
What are your expectations for companies that are starting up or having an IPO? For example, Snapchat. What do you expect from them?
Well, so that's actually a really interesting question, not just in relation to Snapchat, which I think is probably a smoking hole in the ground a year or two from now, for reasons we can go into. But IPOs in general, it's an interesting thing because it's very easy. And I remember Warren Buffett many years ago saying, why in the world would you buy an asset at a time and price of the seller's choosing, which is what an IPO is, right? And so you go, my God, I should never look at an IPO. But that's actually not the case, because companies go public for not always just to sell shares at a high price, but sometimes for different reasons. Think about when Google and Facebook went public. Neither of them went public to raise money. They went public just to give liquidity to their internal option holders. When MasterCard went public, it was because it was owned by a big consortium of banks, and they didn't want to own it anymore. When Chicago Mercantile Exchange went public, it's because the seed holders wanted to make it a public company. All of those businesses were insanely mispriced when they went public. And I think many businesses that go public are still often are mispriced because you have limited historical financial information, and people are naturally more cautious about a business that is not, where they've only got 3 or 4 years of data, right? That hasn't been around a long time. So I would say don't knee-jerk ignore an IPO just because it's newly public in the same way that you wouldn't buy it just because Jim Cramer is flogging it all the time. I mean, treat it just like you would any other business. Snapchat in particular, the one thing I would commend you to pay attention to with Snapchat is what happened to their growth rate in the fourth quarter of last year when Facebook essentially copied their stories feature. The user growth rate rolled over pretty fast. And so I don't know that Snapchat has a path to monetization yet. They may figure one out, but I'm not going there.
Thank you.
Thank you.
Yeah.
Which might be a good segue into a question perhaps with either waiting on Snap to figure out whether they're going to monetize, or with the opportune time in other competitions that we're being involved in to open up a short position on Snap. Your thoughts on short positions, Mr. Dorsey?
Sure. Well, I mean, the thing to remember about shorting is that you can only make 100% and you can lose an infinite amount of money, which is, last time I checked, not the world's greatest risk reward. Shorting is tough generally because time is not on your side, right? If you own a business, even if you wind up overpaying somewhat for it, and it's a business with a management team that doesn't allocate cash stupidly and that has a good competitive advantage and is growing, time is your friend. With a short position, time is your enemy because you're paying for that short position, right? You're paying for the borrow. So, shorting Snapchat, given that Snapchat over the next, say, year or two is probably going to trade more on headlines than on any kind of actual financial results, without guessing those headlines, I would say you'd be taking on one heck of a lot of risk. The short selling is incredibly hard, and the few good short sellers I've met never, ever, ever short because of valuation. They short because a business is fraudulent or fundamentally flawed, i.e. will never make money. And so if you think Snapchat is a fraud, more power to you. If you think the business model is fundamentally flawed, i.e. there is no way to ever monetize it, you probably will do okay in the long run. The trick is, can you make your margin calls in the short run?
Which is probably a very good segue into the company, Dean, if you want to ask about it.
Yeah, there's a certain company in mind, which kind of leads me to a specific question. Like, what are your thoughts on when companies do reverse stock splits?
So what's the company called?
Oh, I guess we have to tell you the name of the company.
No, I'm sorry, I just didn't hear the question.
Dean wanted to know about what's your take on when companies institute reverse stock splits?
Oh, okay. I'm sorry. I just didn't hear the question. Something's probably gone pretty wrong if the stock gets low that you have to do a reverse split. Frankly, it doesn't make one difference one way or the other. It's a little bit like the question Yogi Berra was once asked, which is, how would you like your pizza cut, Mr. Berra? And he was like, "Oh, cut it into small pieces. I'm not that hungry." It's like, well, it doesn't really matter. The pizza's the same pizza, whether it's in 8 pieces or 4 pieces. But I would commend you to look at businesses that don't split their stock. It's actually a very interesting thing to run a screen for businesses with, say, share prices over 150, just to pick a random number. You see this more now than you did 10 years ago. Google has a very high share price. There are Amazon is over $200 share price now. But companies that don't split their stock are implicitly saying, we don't want to cater to investors who are stupid enough to think a $15 stock is cheaper than a $100 stock. Because anyone who's looked at stocks for more than 20 minutes knows that it's about per share value, not value. And so it's an interesting screen to run. Run a screen sometime on companies that have share prices with triple digits. And it's a smaller list than you think. And you'll find some businesses there that you've never seen before that are actually pretty darn good.
because this company I was looking at. Hey, do you want me to tell them the name? Yeah, they're called Dry Ships, and over the course of time, they've done like pretty much 4 reverse stock splits.
In 1 year.
Dry ships? Oh my God. Wow. Yeah. I mean, so yeah, I would say investing in dry ships is kind of like playing poker with Kim Jong-il. You know, I think it's probably a pretty dangerous proposition. You know, unless you're the guy with the VX and not him. No, but seriously, I mean, dry ships is the purest commodity play ever, right? I mean, if you look at the Baltic Dry Index, I mean, it's you know, the operating leverage on a bulk carrier is just insane, but so is the operating deleverage. And to your point on sort of why it's done a whole bunch of reverse stock splits, it's because if they hadn't done them, you know, the share price would be so small you'd need to go over to your high school's microscope to go find it. You guys have an electron microscope at Sussex?
Yeah, and we're the only reason we're asking is one, to get your take on when companies do reverses, is that just grounds for the inevitable, that there is something amiss with that firm that would give us the opportunity to perhaps then open up short positions? Because in various competitions that we're in, we don't have to pay the excessive margin costs like you would have to in real life to open up short positions against dry ships.
Right.
In which case we've done very well. And the fact of the matter that they announced that they're going to pay their shareholders a dividend, I'm dumbfounded that they're able to pay their shareholders a dividend at 6 cents a share. When they do, what's that?
That seems odd to me. I'd say, actually, here's if you're looking for short candidates, the very successful short seller I know, any business that both sells equity, raises capital via equity sales, and pays a dividend. There is something horribly wrong there.
Okay.
Because think about it. I mean, like, why on God's green earth would you raise capital at an 8-10% cost of equity and then pay out the other end as a dividend, unless, as management, you wanted to basically convert equity into cash in your pocket because you have an ownership stake, in which case there's probably something fishy going on.
Okay. All right. Well, Dean has to go on that note, but thank you very much. I put Dean on the spot for that one.
That's right.
I have a very good question from the lone survivor here, because the bus is let out, and
I mean, I got work, but
Scott has to work. But Scott has been with me for the last couple years with various investment competitions. He's very excited about the pitch competition that he's going to do this year.
Super.
Scott, and again, I'm tooting Scott's horn here because he's very humble and he wouldn't. But Scott was accepted to Stevens Institute of Technology, where he'll be majoring in computer science and quantitative finance.
Cool.
So,
yeah.
A
lot of jobs for quants these days.
So Scott, I believe, has a question that he'd like to ask Mr. Dorsey.
Okay. All right. So this day and age, marijuana is becoming bigger and bigger. More states are legalizing it. How do you feel about like investing into like marijuana stocks?
I got nothing for you, boss. Sorry. I've never looked at one. I'm sure there's money to be made there just because it's vastly more acceptable today socially than it was 20 years ago, and it's legal, in Colorado and other places. I think Scott's Miracle-Gro, which is actually a damn good business regardless of marijuana, because they essentially own the U.S. market for turf care. I mean, if you're a golf course or a guy who maintains lawns, there's pretty much nobody else you deal with. But I think it's re-rated quite a bit on this whole marijuana thing because of the hydroponic angle. But it's a great business. It's worth learning about, even if the marijuana air comes out of it, you're still left with a really good business. But in terms of direct marijuana stocks, I got nothing for you. I'm sorry.
Me personally, more and more states are going to start legalizing it. I mean, it's going to happen. I don't personally, smoke the marijuana, but it's going to happen. So, I mean, my dad is actually invested in one stock, and he bought it at 150, went up to 420. And I just think as more and more states legalize it, you're going to see the industry for marijuana, and not even just to smoke it. I think maybe hemp. I mean, there's so many uses for hemp. I think the industry in general for marijuana, medical, recreation, hemp, I think it's just going to keep growing. So if you can find the stuff,
it's a very reasonable proposition. I just I don't personally know any way to capitalize on it, to monetize the insight. I would say if you haven't looked at Scott's, I mean, it's a damn good business, marijuana or no marijuana, and and it obviously, it's not like the number of golf courses is growing 30% a year. So it's been a pretty mature business for quite a while. So if they can get an extra few points of growth per year from hydroponic equipment, that could wind up being kind of interesting. So, but other than Scott's, I got nothing for you.
Okay.
But look, it's reasonable. I mean, and you've actually highlighted something pretty interesting, which is in investing, like half the trick is, okay, what might the world look like in 3 to 5 years? And in your case, more states will legalize marijuana is kind of what you're thinking, and that seems reasonable. But then, of course, the other half is how do I make money off of that? And that's where it often gets trickier and trickier, right? I mean, anyone who figured out that 20 years ago said, "Wow, PCs are going to be the hot thing." Well, I can't think of a PC manufacturer where you would have made money over the past 20 years. Most of them have gone bankrupt. Simply because what was a massive benefit to you and I as consumers, more processing power in a smaller space, was horrible from a manufacturer standpoint. So I think the trick is to find a business which is going to make more money from marijuana, more marijuana sales, but also has some kind of competitive advantage, right? It's going to be around in 5 years, and it's going to be able. You're not going to have other people flooding in with competition for it.
yeah.
Well, sorry. Thank you, Mr. Dorsey.
Sure. Yeah. I'm sorry. I don't know more about pot stocks.
Don't worry.
All right.
So, okay.
Well, thank you, Tech. I will take it from here. But thank you.
All right. See you.
And good luck on the stock pitch.
Oh, thank you.
All right. Anything further from me, Mr. Fletcher?
That's it. Very good.
Mr. Dorsey?
Thank you, William.
That's it. Again, my apologies for the connectivity issues.
That's all right.
No worries.
It's all right.
All right. We'll be in touch.
Okay.
Yep. Bye.
Thank you.
All right, Pat, why don't I kick it off with a couple more questions and then we'll let you go. I would love it if you could walk us through 1 or 2 examples of how you think about a stock, whether it be Facebook but just walk us through the due diligence process and the investment thesis. We have hundreds of kids preparing for their stock pitch competition in May. And I think your expertise on how you look at a stock will help them a lot.
I mean, sure. I mean, so the one thing I would just to bear in mind is that there is, I think, a difference between investing in real life and a stock pitch. And I say this because their goal right now is to win the stock pitch.
Yeah.
Right?
Yeah.
And I think of this because the guys come there dry ships. I vividly remember being at a stock, like a very good MBA program, stock pitch, 6-7 years ago, and dry ships was pitched, right?
Yeah.
And the trick is that basically the pitcher left out the single most important point, because this was at the top of the commodity cycle, and you had a ton of older oil tankers being converted to bulk carriers. So there's tons of supply, like just about to come on the market and just crater prices. But the person who was pitching either didn't know this or didn't mention this. None of the judges asked her that.
Yeah.
And so, but because she was really convincing, right?
Yeah. Yeah.
So I would just remember that, you know, and this is more for if you're like, you know, you're the loser in the stock pitch. It's not always the best pitch that wins. It's the one that sounded the best. It's not, you know, because it's not like they go back a year later and say which one made money. But I would say in terms of, you know, thinking about your pitch, in terms of doing one, you know, make sure it's a business you can understand, and don't ignore non-consumer businesses. I think stock pitches often kind of, especially at maybe the younger high school kind of, they default to Under Armour. They default to things that people have personal experience with, which is okay, but just because I visited 2 Under Armour retailers doesn't mean I know a lot about Under Armour. Whereas, you know, if you, would be a good example. You know, if you have, if you talk to 5 mechanical engineers about Autodesk, odds are you're getting a pretty good view on Autodesk because it's really only got a couple competitors, right? You know, because the user base is much more concentrated. So you can understand, that would be number 1. Don't ignore management. I think that's a flaw of a lot of early stock pitches, is to assume management is brilliant. They know what they're doing. You know, spend a little time looking at their track record, acquisitions. Have they bought back stock at the wrong time? That will, I think, make you stand out relative to your peers. That will definitely make you stand out. Even the tiniest amount of primary research will help you stand out. You know, don't just rely on whatever brokerage reports you can cobble together and that sort of thing. You know, get out there and, you know, like if you're doing, let's say you're pitching McDonald's, just for example, go talk to a couple store managers, you know, and say, what's it like to be a McDonald's store manager? What's your relationship like with a franchisor? You know, it will set you apart in a big, big way. I mean, I was on the board for University of Texas, their MBA fund for a number of years. And I still remember one team pitching Buffalo Wild Wings, you know, and we asked the team, have you talked to a franchise owner of Buffalo Wild Wings? And I'm like, this is Austin, Texas. I'm positive there's one here. I haven't looked, but I mean, beer and wings, large college town, there's gonna be one here. And they hadn't. You know, and it was like, we didn't ask you to fly to Japan and like go to a robotics factory. We asked you to go have a beer somewhere and talk to the store manager. You know, it wasn't that hard. So if you don't do that, even doing that a little bit really, I think, can set you apart. And you know, so doing a little bit of work on management and their track record and their compensation, a little bit of primary research, business you can understand, and then, you know, if you're you're probably doing this on teams, I would guess. Usually people do this in groups, and so get one member of your
they do it in pairs.
Get one member of your pair to take the other side. You know, you know, what kinds of hard questions am I going to get from the judge? If I thought you were, if I'm the PM you're pitching this to, and I really was skeptical, what would I be pushing back to you on? And that way you'll be, A, you'll tighten your pitch, and B, you'll be prepared for the inevitable zinger when you go, oh, hadn't thought of that.
Yep. All right, great advice. And do you have an investment idea that you've invested in the past or you're invested in currently that you would walk us through why you invested in it?
Oh, sure. I mean, I'll talk about Facebook. I mean, it's one that you're probably all familiar with. You know, and I mean, it's one of those ones that's, it seems almost too obvious, but, you know, here's a business with a $20 billion plus top line that's still growing at over 50%. You don't see that real often. And moreover, you know, so the global advertising market is roughly $650 billion, give or take, depending on whose numbers you want to use. But it's big, okay? Whether it's 600 or 650, that's a lot bigger than 20, which is the $20 billion that Facebook's currently doing. You know, advertising grows a little faster than global GDP, so call it 3-4% a year, But as you might imagine, digital advertising is growing significantly faster than that, given that print is declining very quickly and the amount of time people are spending on mobile devices and tablets and whatnot is increasing. And advertising follows eyeballs, right? Or ears back in the radio days, right? I mean, you think about it, originally advertising was a sign painted on the side of a barn, right?
Yeah.
So-and-so chewing tobacco, right? Because that was the only place you could put it. And then you had newspaper, and then we have newspapers and you have ads there. And then you have radio and you have ads there. And then you have TV and you have ads there. And now we have PCs and you have banner ads, God forbid. Then you have mobile phones, and then you have, ads in the feed, right? But you see the pattern here, which is simply that advertisers follow attention. Wherever people are, that's where advertisers need to be.
Yeah.
Because I'm not going to say because you figure it's not too hard. So as more and more people spend time, as more and more of the finite amount of attention we have, right? There's 24 hours in a day. People sleep 6-8 hours a day. So there's, call it 18 hours of attention per day. And so a lot of it is taken up by work, shopping, or whatever. But that isn't growing, right? I mean, it's the number of hours in a day isn't growing. So there's a finite amount of attention per day. That attention is increasingly being spent on digital devices. And two companies get 80% of incremental digital ad spend. That's Facebook and Google.
Yeah. Right
now, Google has about 8% market share, 8% share of digital advertising. They've got about 3x the revenue of Facebook, give or take. And that's really interesting because there's certain things Facebook can do that Google cannot do, right? Google only knows things about you because of where you visited, right? Cookies on websites.
Yeah.
Or because you said, I'm looking for a good lawyer, or I'm looking for, actually, believe it or not, the highest paid keyword on Google right now, DUI Dallas.
Really?
Not joking on that one, right? It's a pretty specific request, right? And so if I'm a lawyer in Dallas, I want to pay a lot for that keyword. But think about it if you're Nike, right? Let's imagine you're Nike or you're Under Armour, and you want to elicit an emotion from someone. You don't want to get them to buy this specific thing. You want to get them to have a good impression of Under Armour or of Nike. How do you serve information to someone who might not be searching for a Nike product, but who's in your demographic?
Mm-hmm.
Google has a harder time with that, right? Because it's all what's called direct, it's mainly what's called direct response. Whereas Facebook, you can push an ad at you based on your characteristics, right? Maybe you've never actually bought athletic apparel online, right? But you are connected to a lot of people on Facebook who have, or you follow famous runners. That is really valuable information to me if I'm Under Armour or Nike.
Yep.
And that's something that Google not can't do, but has a harder time doing. Google also has a harder time with rich media, right? Because Google, you're gonna view Google on maybe on Chrome, on Safari, maybe on Firefox, on different websites. It's harder for an advertiser to control the user experience via Google. Whereas via Facebook, the advertiser knows exactly what you're going to see, what you're going to experience in terms of imagery. So that's really appealing to an advertiser.
Yep.
So given all those facts, why shouldn't Facebook be the size of Google in terms of advertising? I mean, our thesis is a little more complicated than that, but you kind of boil it down, and we can't figure out why they shouldn't be about the same size.
Yeah.
Especially given, if you're Facebook, you don't need to pay the traffic acquisition costs that Google does. Which is one reason why, Facebook runs a high 40s margin and Google runs a, mid 20s margin. I mean, the flying cars and the drones and stuff are the other reason at Google. But I mean, Ruth Perot is introducing a lot of financial discipline there.
Yeah.
That's Facebook. I mean, basically, I was pretty skeptical of Facebook when we first started looking at it because I'm thinking, okay, 20-something billionaire. He's just going to waste capital. He's going to buy stupid stuff. And then we kind of looked at Instagram, which Instagram was 12 people, no, 20 people when he bought it.
Yeah.
Paid $1 billion
Yeah.
for it.
Yeah.
But what the heck? Look at Instagram today, 7 years later. I mean, that was pretty smart. That was a pretty smart acquisition. And Zuckerberg also, Don Graham from the Washington Post was one of the early board members at Facebook. That's interesting, right? I mean, that a 20-something billionaire would have the kind of intellectual maturity to invite kind of a non-tech guy, but who has a pretty good track record as a capital allocator onto their board. So I remember that sort of perked up my ears and said, maybe there's something going on here.
Interesting. Well, I mean, to your point, Pat, I think you painted it beautifully. Is the history of advertising is that you follow the eyeballs, and the pie is much bigger than maybe we expect or give it credit for.
Yeah.
But I guess the follow-up question on Facebook is always, well, how do we know the eyeballs will stay on Facebook? How do we know 5 years, 10 years from now that the eyeballs won't move somewhere else? And then we have, a lot of teenagers watching that would say, hey, I don't use Facebook, I use Snapchat. I use, another product. So how do you look ahead 5-10 years?
Totally fair question. And if you told me you have to pick one investment that you can lock in a closet and come back in 10 years, it probably would not be Facebook.
Mm-hmm.
Right? Because the landscape is just moving too fast. Right?
Mm-hmm.
This is not Coca-Cola, gang.
Yeah.
Right?
Yeah.
But so far, Facebook has responded to, so as we discussed a few minutes ago, Facebook saw that people were basically younger people were debating whether a picture is Instagram worthy. And they were they were reluctant to post things on Instagram because it stayed up there forever. People liked the ephemerality of Snapchat. And so Facebook said, well, imitation is the sincerest form of flattery. Let's do the same thing.
Yeah.
And in that feature of Snapchat, I think it's called Stories, has become massively popular and has actually kind of rolled over Snapchat's growth, which I think is interesting in that it sort of shows a willingness not just to innovate but to learn. Because I think a lot of companies, if you're as dominant as Facebook is, like, oh, the way we do it must be great. The way they're doing it must be stupid. Well, in this case, no. The way Snapchat was doing it actually served the needs of that demographic better. And so that's an interesting competitive response. You also saw about 6 months ago, Facebook deprioritized sponsored posts. So they noticed kind of a decline in user engagement. And they changed their algorithms so that posts from your network were going to get pushed higher in the feed than sponsored posts.
Mm-hmm.
If you think about it, from the point of view of their customers, advertisers, that's bad.
Yeah.
Right? I mean, Facebook basically said, hey, guys who are paying us lots of money, we're going to do something that disadvantages you in the short run. We're not going your ads aren't going to get pushed as high, but it builds the business in the long run because it keeps user engagement high.
Yeah.
Because without, as you pointed out, without user engagement, there is no network, and that's what killed MySpace, right? I mean, MySpace just you got when News Corp bought it, got blasted with ads, horrible user experience. People left for Facebook, and so I think that our view is that Facebook is hyper aware of the risk of declining user engagement, and as we've seen those couple of examples, they're quick to innovate and quick to when people have something better like Snapchat, they'll copy it. Things like Facebook Live, they're innovating at a very rapid pace. So yeah, but the risk is there, right? I mean, 16-year-olds may not want to be on the same social network as mom and dad. Okay, and so when those 16-year-olds become 26, 10 years from now, will Facebook be as dominant as it is today? I don't know. Totally honest with you, I don't know. And it's the position that we have. We probably watch the most closely. We go to a lot of digital advertising conferences and basically talk to the people who are directing ad dollars towards one social media platform or another to understand what kind of value they're getting, what kind of ROI they're getting. 10 years from now, I think they'll still be pretty dominant, but I don't know.
Yeah, yeah, yeah,
This is a stock where I'm happy that we have liquidity.
yeah, yeah. All right.
I
Very.
mean, look, and the key thing is that the current valuation does not assume dominance 10 years from now,
Uh-huh.
right? Facebook currently trades at about 16 times forward EBIT.
Yeah, yeah,
Well, it's closer to 17 or 18 now. But I mean, think about it. 18 times EBIT
yeah,
for a business that's growing over 50% and posted 1,000 basis points of operating margin leverage last year.
yeah.
Doesn't seem
Yeah.
egregious to me.
That's that has very little capital expenditures and
Oh yeah,
and high returns on capital.
Bazonkas, it's a technical term. You know, I mean, and I think one of the reasons why the stock is so reasonably priced, you always have to ask yourself this, right? Like, what am I missing?
Yeah,
I mean, sandbag might be too harsh a word, but I mean, you know, last year they thought they would spend like $2 billion more in CapEx than they wound up spending in 2016.
Yeah.
OpEx came in a lot lower than they guided.
yeah,
You know, and they've been telling the street, hey, you know, ad load's going to really ramp down, growth is going to slow. They've been saying like 6 quarters.
yeah,
It's not slowing. And
yeah,
but the reason from their perspective is very obvious, I think, which is that so many of their engineers are paid in stock comp, right? And if you think about, if your people are paid in stock comp, what you want is a very slowly, steadily appreciating stock,
yeah,
right?
yeah,
Stock that's doing this all the time, then you could have a group of people who joins the company and gets their stock struck at some high level just because randomly people got excited about Facebook that month.
yeah,
Then they get pissed off. Right?
yeah.
2 years later, they're like, my shares are underwater. Come on.
Uh-huh, uh-huh.
That way. Whereas you just kind of have this, everybody wins.
Yeah,
I
yeah,
think that's one reason why they've been so cautious in kind of, you know, their tone.
Yeah.
They're not hyping it at all.
yeah, yeah. Makes sense. Makes sense.
Well, we'll see. I mean, you know, we think we'll do well, but
Yeah.
we worry about it just like we worry about all our positions. If you have a position you're not worried about, and then you're probably in trouble.
Uh-huh, uh-huh. So tell me about that. So we had Guy Spear on a couple months ago, and he talked about building an investment checklist, and as part of that, it's basically rounding up all of your mistakes that you've made over your career and coming up with a checklist of how to avoid those mistakes. So maybe tell us about a mistake that you've made, and what you learned from it, and I think that could be valuable for a lot of these young investors starting out.
Sure. Wow. I mean, how long do we have? That's the real question. I'm just kind of going through kind of my list and see which of the ones is going to be most valuable.
Yeah.
I think the single biggest lesson is to avoid endowment bias, right? That, you know, just because I own this or I have owned it, it's special, and I should trust management more than something I've never seen before, right? If something surprises you, if management is unable to answer a question that, you know, you think is reasonable, and kind of undermines your confidence in their ability to manage the business, and you don't need to own it anymore. You know, it's I think, sorry, yeah, it's a pretty big one. And I guess the thing I would keep coming back to on that one is simply, and you can never set too high a bar. Maybe that's the way to put it, either on management or on the business. you know, as an investor, you don't need to own 100 stocks, right? You're not running a Fidelity mutual fund. You know, you need to own 10 in your personal account, or, you know, if you are a relatively concentrated child, maybe it's 30, right? But so you can just throw out lots of things, and you can just say, look, that doesn't meet the bar. That doesn't meet the bar. Like, you know, I think the guy pays himself too much. I think this business has too much commodity risk. Don't be afraid to say no. I mean, I've definitely gotten into trouble when I have not been willing to say no. And I thought that, you know, either investors who were smart, but just had a different style of investing than I do, you know, they owned the business, and I was like, wow, they listen to something I don't. It's like, well, maybe we both know an equal amount, but they're playing tennis and I'm playing football. Look at me, needless to say, I don't play football. You can figure that out pretty quickly. But you see my point, right? I mean, you have to kind of know what game you're playing. And I mean, I actually have a sticky on my computer that says no FOMO, fear of missing out.
Fear of missing out,
which is a biggie, right? And you know, because you see somebody else making money off of something and it doesn't quite meet your quality standards or isn't really in your wheelhouse. You go, wow, they must know something I don't know. It's like, well, no, maybe they're just playing a different game than you are, right? Maybe, you know, so I think my biggest mistakes have definitely come when I've, you know, not kept the bar as high as it should be in terms of management quality or business quality, because that's what I'm good at. I stink at deep value. You know, I mean, there's things I cannot do, and I shouldn't go there.
It's tough though in investing though, because there's always a bit of uncertainty, and even in the best, cleanest investment ideas, there's always, you know, maybe a little something that kind of irks you. And so how do you know if that irk is significant, or how do you know that it's not just, it's the buying opportunity and the market's, you know, missing this, the long-term opportunity from the short-term noise in front of them, right? So there's never full comfort, and if it feels too good to be true, it often is too good to be true.
Yeah, no, that's a great point. I mean, because if you're continuously looking for perfection, you frankly will sit on a lot of cash for most of your life. If you demand perfection in every investment, because there is no investment that's, you know, has an amazing moat, a long runway for reinvestment, and is run by an angel. Sorry.
And trading at 10 times earnings.
No, not going to happen. You know, so you're totally right that you need to just decide, is that flaw fundamental to the thesis or not? So I'll give you a couple of examples. So there was a phenomenal software company we looked at a couple of years ago. That was just utterly dominant in Europe, utterly dominant. But they had screwed up their U.S. business like you wouldn't believe. They didn't offer, you know, European businesses tend to buy perpetual licenses. They put a bunch of money up front, they perpetually own the software. U.S. enterprise customers of enterprise software, they tend to prefer not subscription, but like, you know, the lower upfront and then a maintenance fee, right? That's the model that they prefer. And they never offered that payment scheme in the U.S. And it was one of the big reasons why they hadn't been able to sell the software. It was just kind of like, duh, you know. I mean, like opening up an Italian restaurant and not serving pasta. I mean, just like, why do you think you're not successful? You know, and so there's you know, things like that just, you know, and we met like their U.S. director of sales, and he was okay, but not great, and he was touted as like the great white savior of that piece of the business. But we spent all the time worrying about that and not paying attention to the 95% of the value that was sitting over in Europe. You know, and it's just stupid. So that was a flaw. That was a flaw in the business, but it wasn't a fundamental flaw. And that's one where, you know, you can't, you know, often great businesses get mispriced because everyone is focused on this small piece that's underperforming while the rest is doing just fine. We fell into that trap with that. You know, whereas there's another business that we looked at that was, it was a massive turnaround story. Prior management had basically done a huge roll up for 15 years. Eventually, things fell apart. They got indicted for defrauding the UK government. And the thing was, I mean, you had a massive, entire C-suite left. Like most of the country managers got booted. Most of the board got booted. I mean, it was the biggest house cleaning you've ever seen. And so a lot of low-hanging fruit. I mean, this business was the world's third or fourth largest global employer, private employer, and they didn't have one global telecoms contract. Like they called up Vodafone and saved like £6 million with a phone call. Just by saying, hey, could we centralize our business with you? No one had bothered to do that before. So all this low-hanging fruit, whatever. But at the end of the day, it was like a business that was like 5.5 out of 10. It was above average, but not by a whole lot. And I think like I'm above the average height of an American, but by about like half an inch. I'm not a tall guy. And so that's what I mean by that was like the not keeping the bar high enough, right? It was a turnaround story, and the business, it was a better than average business, but not by a whole hell of a lot. And so I think to your point, you're right. You have to be able to withstand hair on the business. Maybe the manager's paid a little bit more than you would like, or this is one division that's underperforming, or whatever it might be. Oh God, another one, Jesus. This wonderful little UK conglomerate bought small capital-like businesses, fixed them up. They paid out like 40% of earnings as a dividend, and we just asked point blank, like, why? Like, you guys have generated like high teens returns on capital. Why not just keep the money and reinvest it? You're like, well, our shareholders kind of expected. We've always paid a dividend. No, that's not perfect or optimal. But like, do you really want to kill the thesis because of that? Right. I mean, so that's again my point. That doesn't destroy it. It just makes it imperfect. Like there's imperfect, and then there's I shouldn't go there. I don't know if it's a good answer.
Yeah, it's like Buffett's too hard pile, right?
Yeah. Well, not even just too. I mean, I wouldn't even. I see. I actually don't like that too hard phrase. I wouldn't even say too hard. I mean, there is too hard, right? If you're not a biotech expert, for God's sake, don't compete with biotech investors, right? Because you've got hedge funds with 18 PhDs on staff. That's too hard, right? But there's also just doesn't suit me, right? Doesn't suit my style of investing. Doesn't suit who I am, right? I should not go to the beach in a Speedo. I just should. It doesn't suit me, right? It doesn't mean that. And so in the same way, like this turnaround story we were talking about a moment ago, we shouldn't be doing turnarounds. It's not something we're good at, So that's what I mean by like the too hard bucket is fine. But I think people think, oh, this business is understandable. I can get it, But does it fit your personality? Does it fit what you're trying to do as an investor? Because I think that's where you frequently see investors get into trouble, where they get out of their wheelhouse, right? They try to be activists when they're not activists, or they the value guy who decides to own Amazon. Or, that doesn't really happen. What I mean? So that was my just. The too hard bucket does matter, but there's also the just doesn't suit what I do.
Doesn't suit. So, Pat, one last question, and I'll let you go. So, in your book, A Little Book That Builds Wealth, you talk about you go through the different moats that you look for in businesses, and we teach our students about these moats and. Warren Buffett coined the term economic moat. And, so there we're learning about network effects. And we talked about Facebook earlier, that they would have a network effect moat, route density, low cost advantage, brands. And so there's different competitive advantages that we can look for in companies. I'm just curious, in your portfolio and when you invest, are certain moats stronger than others? Do you tend to favor a certain type of business, a certain type of moat that you look for, or is it whichever one is at the best price, then you would look for that advantage?
Yeah, So again, a lot of this comes back to what are you trying to do as an investor and how much capital you're working with, right?
Yeah.
You know, Berkshire Hathaway tends to have a lot of big branded companies in its portfolio because these tend to be big businesses. And he's got a couple $100 billion he's working with. And that's his investment universe is kind of necessarily smaller, right?
Smaller.
You know, we at this point have a relatively small pool of capital, and we intend to keep it small. We're going to cap it at a certain point. So we're unlikely to, frankly, ever own a big CPG company, absent a huge dislocation in price, simply because we're probably going to find better returns elsewhere, right? Because those businesses don't tend to have a lot of reinvestment opportunity, and it's that ability to reinvest where you really maximize the value of it. So I think some of that just depends on kind of what you're looking for as an investor, what your capital base is, what you're trying to do. That what I would also say, and this is probably something I didn't focus on enough in that book, that because at Morningstar, our equity, our coverage was kind of more, it was mega cap skewed, right? And so there was definitely more of a focus on, the business with the established moat, the Costco, the Coca-Cola, the Unilever, whatever.
Yeah.
But the real money, I mean, if you're thinking about, really compounding capital over time, it's not the business that has built the moat, it's the business that is building the moat, right? Because that's probably a business that's younger, that's got a longer runway ahead of it, and where each dollar of incremental cash flow is being invested at a progressively higher incremental return on capital as the business gains scale, as the competitive advantage widens. And that's where the Mungarian Lollapaloozas come from, right? And so I think that it's very easy if you go down the path of thinking about yourself as a quality investor and I only invest in companies with moats and blah, 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 to kind of skew towards the inevitable. Where, and again, if what you're doing is managing a don't get me killed portfolio for a bunch of retired families, great. Like that's probably what you should do. If you're managing $200 billion, that's probably what you should do.
Yeah.
But if you're working with a longer time horizon, a little bit more volatility tolerance, and a smaller pool of capital, the businesses that are building those moats, the moat isn't there yet, but management is taking the right steps to each year widen that competitive advantage, those returns are probably going to be superior.
Yeah. Sounds like another book.
Sadly, the ROI
on
books kind of stinks. Let me get this business off the ground first.
Well, the ROI is high for the rest of us.
I often get asked, like, what's your favorite moat, or do certain kinds of moats kind of predominate in your portfolio, and this and that. It seems like a cop-out to say it depends, but it kind of does.
Yeah.
This business is, Munger and Buffett talk about this, right? This business is about learning. And, I think that 15 years ago, you said, what's some of the most stable moats in the world? And it's big consumer branded companies.
Right. Yeah.
Well, now let's look at what happened with Dollar Shave, Unilever, and P&G. Right? I mean, Dollar Shave did not exist 6 years ago, 7 years ago, whatever the number is. And the only reason it can exist today, and it couldn't 15 years ago, is because they can get that message out and market to people in a vastly cheaper fashion than they could 15 years ago. 15 years ago, you had to buy an ad on CBS or QVC or whatever. Now you post an awesome YouTube video.
Yeah.
$500, whatever it costs. So, I mean, I think, the moats of even the biggest CPG companies, I mean, I'm not going out and shorting P&G tomorrow, but they, the barriers to entry are lower.
Yeah.
As the ability to reach and market to a critical mass of potential customers is vastly lower today than it was 10 years ago.
Yeah. Yeah.
And you know, when you think about it, I mean, what's the barrier to entry to building a brand? Reaching people.
Mm-hmm.
15, 20 years ago, that channel was 3 networks in the US.
Yep.
And some cable networks, right? Not just 3, you know what I mean?
Yeah.
But media is vastly more fragmented today. And so the ability to take a niche brand and hit critical mass is enormous. I mean, look at Greek yogurt. What's the name of that company in upstate New York? You know what I'm talking about. Anyway, I mean, just came out of nowhere.
Yeah.
Wouldn't have happened 20 years ago.
Yeah. That is a really good point. That is a really good point. The barriers to entry of building a brand is much less today than it was 10 years ago.
Yeah, and again, it's still not easy, right?
Yeah.
But I think that it just shows how little you can take for granted in this business.
Yeah. 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 Yeah.
You know, I mean, Nokia, right before the smartphone. I mean, you know what? 45% global unit share or some crazy number like that. How do you overcome that kind of scale advantage? Like, there's just no way you can overcome that.
Yep.
Until you do.
Yep.
Right? Until you know you miss the boat on the smart. And look, they were one of the first with the feature phone too. I mean, you remember that old James Bond movie when he's like sitting in the back of the BMW, like driving the car on the Nokia phone? Remember that?
Yeah.
They were one of the earliest smartphones, right? But you know, anyway, it's you can't take anything for granted.
Yep. I think, I think as much as us investors, especially high quality investors, try and say, you know, we're building a moat around our companies have a moat and we're investing for the long run and this is our sleep well at night portfolio. The reality is we always have to be on. You always have to be analyzing the latest trends. And yeah, like Buffett says, it's learn, and you're always reading and always learning.
Yeah, I mean, so we're doing a lot of research on a company called Dollar General right now, one of the larger businesses. You know, I mean, Walmart has been losing share to the dollar channel, both Dollar General and Family Dollar, for several years now.
Yeah.
And it's because Dollar General figured out that it's frankly a pain in the butt to get in and out of a Walmart.
Yeah.
Right? I mean, when it's a couple 1,000 square feet in a massive parking lot, if all you need are milk and eggs, no.
Yeah.
And so if you can have a footprint that's about the same size as a drugstore, but you're pricing things at the same level as a Walmart, and it's kind of small basket size consumables, the value proposition to the consumer is pretty crazy.
Yeah.
You know, so it's like Walmart figured out how to win against small town merchants and Kroger and Winn-Dixie, but the scale that allowed them to win, that scale itself opened them up to competition.
Yeah. Interesting.
Convenience, right? You know, I mean, so now you're seeing in rural America, a lot of people, they do kind of a weekly or a monthly trip to Walmart and kind of fill up on things, but then they do kind of a once a week or twice a week trip to a dollar store to kind of, you know, they ran out of shampoo, you know, they need eggs. And then while they're there, they get a soda, they get, you know, a higher margin beauty product.
Yep. Makes sense. All right, Pat, this has been a tremendous pleasure, and we are so excited to have you and for all of your wisdom. I took notes today.
The advice is worth what you paid for it.
Well, your advice and your wisdom have been tremendous in my life and my career, so I'm grateful for it, and it was great to catch up today. So thank you.
Yeah. Take it easy. Good luck, everybody.
All right. Thank you, Pat.
Bye.
Bye. All right.